Uncertainty surrounding trade, the currency battle between the U.S. and China, that's all resulted in some dramatic swings in the bond market this week. Joining us now to discuss is Kevin Giddis, the Executive Vice President and Head of Fixed Income at Raymond James. So Kevin, let's just start with your take on the action this week and really what we've seen in treasuries over the last couple of months, because we had a longer-term chart up there with 3% on the 10-year not that long ago, and all of a sudden, we basically take it as a given we're going to get back to that record close at 138.
You know, it's two significant things. One, the Fed blinked at the end of the year, and then everything that's followed that has been about trade. So, and you got to think about how do we get from 205 to 160 and then, of course, back up to 173. It centers around trade. Mm-hmm. I mean, because inflation, it's always been an inflation story until trade took it over. So you got inflation, or the lack thereof, over here. It's a trade issue now.
So one question that I have, and it's kind of hard because it's been so noisy since the Fed meeting, which feels like a million years ago, but it was only on Wednesday, was that ideally the cut was going to help steepen the curve again. So if you were to try to adjust what we've seen in the 10-year for the trade issue, do you think that actually would have been the outcome of the Fed hike in a vacuum?
Probably so. If you took the trade, so what we're finding out is this particular trade war isn't inflationary. So what you worry about is that it might be inflationary and it may be harmful to the economy. It looks like it's just harmful to the economy at best, and we don't even know it's going to be that so much. It's definitely not inflationary. So the concern, if you took that off the table and you just dealt with a single cut by the Fed, we would probably maintain that 20 to 25 basis point spread between 2s and 10s. Instead, you know, we rocked it down to about 14 and then to 8 and then back up a little bit to 11 or 12. There is, for a bond guy, the volatility we've been waiting for, we've got it. We just got it in giant, you know, bucketfuls versus spoonfuls. But if you took that away, yes, I'd probably say there's still some decent curve spread.
Now, something we talk about sometimes in the stock market is the way that algorithmic traders or the technicals of the market will create these big swings. When you're looking at treasuries, it does feel like we've seen similar instances, and I'm just wondering if you look at this week as partly worries about trade, but also, I mean, that move that we saw really Monday through Wednesday was pretty violent. I don't know if that was totally fundamental. It certainly felt like there was a liquidity issue in there to some extent.
It was a clearly risk-off trade out of fear that this trade war was going to extend maybe until the next election. So we don't know. Mm-hmm. That fear really sent investors out of all types of risk assets, whether it was equities or whether it was high yield debt or other securities straight. So that was the kind of the flood trade that happened. After that, it's been pretty orderly. Liquidity has not really ever been a problem. And I always hate when we start conversations about bubbles in treasuries, especially that it exists today. It doesn't, and it won't for the near term.
So in terms of interpreting kind of where we stand right now, obviously everyone concerned that if the 2 dips below the 10, that's the bellwether of a recession coming soon. Right. What event do you think would kind of catalyze that in the first place? And then B, given where we are right now, being as narrow as it was this week, how panicked do you think people are at the moment?
I don't think they're really panicked right now, but so there's a couple of, we were talking about this earlier, the data itself. Does the data matter any longer? Is this simply about a tweet from the president, a trade war between U.S. and China, the lack of inflation, and what the Fed's going to do, or the expectation of what the Fed's going to do? There are some data points worth watching. Anything that has to do with inflation, we'll continue to watch. Mostly these manufacturing indices, if we start to see, a lot of them are teetering around this 50 level. Mm-hmm. When you start to push below 50, now you're starting to get into real recession potential, and that's where the market's going to probably be most vulnerable to over the next 6 to 8 weeks.
And where do you think the 10-year's headed, let's say by the end of this year?
You know, it's kind of funny. I'm preparing for a speech next week, and so I submitted these slides like a week ago, and then now I'm like,
you got to redraft it up.
And then you resubmit them. I've done it twice this week alone. For me, I'm still sticking at about 150 for 10s, and I probably started the year off at 225. I was been pretty bullish, got to 175 and then to 150 pretty quickly because I think the Fed maybe 2 or 3 times between now and or the end of the year. And that likely fits.
All right. Talk to you soon. Kevin Giddis, EVP, Head of Fixed Income at Raymond James. Thanks for stopping by. Have a great weekend.
You bet. You too.